Okay, so in this class, we're talking about the effect volatility has on the delta. And so we know that there's three things that move the option price. And so far, we've talked about the effects of the movement of the underlying stock. We talked about how time and the movement of time affects the delta pricing. And now we're going to talk about the effects of volatility. Now, when it comes to time and volatility, these I had to go into a lot more in detail with the other Greeks like Gamma, Theta, Vega, Charm and Rho, and all those, because there's some concepts that you have to understand. That way, you can understand what kind of strike price to pick, what kind of expiration date to pick based off the strategy that you're trying to play, and it's good general knowledge just to see how they're using options to move the market around. So consider the time effect and the volatility effects on the delta as like the introduction to like these higher level concepts. Now I want you to think like this. We know that time and volatility are connected, and they're connected because they expand the probability range of the stock moving that option position into the money or out of the money. So with volatility, we know that the higher volatility level expands the potential range of the stock the same way more time increases the potential stock range. And that is known as Trumpification, right? And Trumpification is defined as a delta effect caused by time or volatility movements in which the delta of in the money options decrease towards 50 and the delta of out of the money options increase towards 50. Because remember in the time effect class, I said all options tend to magnify the further out in time towards the 50. So the delta at the money options holds steady 50, around 50. Now, why is Trumpification important? Well, it shows how an option's delta changes as the option approaches expiration or hits volatility. Many investors don't understand that their positions can change even though the stock does not move, the stock price doesn't move up or down. Like those changes can lead you to unexpected losses. And so understanding this Trumpification effect on the delta due to time or volatility, is very important. So let's look at the Trumpification effect that volatility causes with the delta, right? So let's look at the picture. It shows the delta of all the calls listed by month and strike, with the stock trading at, let's say, 65 with 30% volatility. When we looked before, we saw the range of delta in each month listed. June had a high of 100 deltas to a low of 0. Delta at a 30 volatility compared that with the call chart of a volatility of 70. So let's put them side by side and look at the range of the delta in June at 70 volatility, a high of 96 delta to a low of 12 delta. You can see the range in July, the range was 88 delta to a low of 26, and continue to notice the range of the next month delta, and then go back and compare them to the charts that run at 30% volatility. I want you to really notice the change in delta, the delta's range from a 30 volatility to a 70 volatility. Look at the January and compare both volatility levels head to head. Under the 30 volatility, the range is 90 to 26. Compared this to the range at a 70 volatility. At 70 volatility, the range is only 78 to 49. Look how tight all of those deltas are under the 70 volatility table. They're really clustered around the at the money strike. Notice how tight they are. That is Trumpification as caused by volatility. Okay, so let's wrap this up. Like, what's the why? Like, the why behind Trumpification. Because if you understand Trumpification, you understand how time and volatility affects the delta of your option position. If you're long some in the money calls and volatility is up big in your stock, you would know immediately that your overall delta position has decreased because of Trumpification. How does this affect your money position? Well, you've been preparing for this because you know that Trumpification affects in the money caused by decreasing the deltas. And out the money increases due to volatility. You cannot control the change of the delta due to the movement of volatility, but you can prepare for the possibilities and not be surprised by it. So you probably have a better understanding of your positions than most traders if you know what's going to happen to the delta. So depending on where your option deltas are located, in the money, at the money, or out of the money, you will know what volatility increase will do to your delta position and what a volatility decrease will do. Here is the importance of Trumpification. Knowing how your overall delta position will change with volatility and movement in time so that you can be prepared to take the appropriate action. Now, a little trick that I learned a long time ago that I forgot who taught me it, but low volatility is when institutions like to buy stocks, bonds, whatever. Like some of you guys might know this as the accumulation phase or the consolidation phase, right? High volatility is when, like they like to sell. So low volatility seeks buyers, high volatility seeks sellers. Just remember that. Hopefully this makes sense. All right, so from here, we're going to move on to the gamma class and hang on because gamma is amazing. When I teach the option pricing models classes, this will make a whole hell of a lot of sense to you. And it will even make sense to you when we start going to the Vega class and the gamma squeezes and stuff like that. All right, later.